you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions.
Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall, and here with me today is Michael Hume, manager of the Carmignac Portfolio Commodities Fund. Hello, Michael.
Hi, Emma.
So commodities, we may as well start with the most pressing subject in the sector, the oil price.
Quite.
Down from $110 per barrel in July to 56, I think we are about now. What's happened and what's going to happen?
Well, I mean, that's the $64 million question. I think we've had a considerable period of volatility in oil prices recently. And I think it's no surprise that that has followed a period of a number of years of stability. It's almost like a Minsky moment. Hyman Minsky probably should have run a Nobel Prize for his work. This period of stability, in a way, has, with a quite elevated oil price, north of $100, has set the scene for quite considerable supply growth coming out of particularly North America, and particularly within North America, the shales, the US shales of the Eagle Ford, the Bakken, and to a lesser extent the Permian. Now that supply has been building up over that period of years, and OPEC has really sort of struggled to cope with that incremental supply, cutting production here and there, and there have been various capacity outages, which have kept that stability, if you like, going for a little bit longer than most people would have predicted. And then in the summer of last year, what we noticed was that supply was beginning to have more of a profound impact on markets. And I think when we saw that sort of appear in the storage numbers, inventory started to build. The rapidity of growth in the Eagle Ford really started to have an impact on markets. And then we saw a big spike in Libyan production and quite considerably tight markets elsewhere in OPEC in terms of higher levels of supply. Then we saw something give, and that's when we saw the oil price really collapse. And I guess the icing on the cake, if probably the wrong thing to call it, was obviously Saudi's decision not to cut production. Unsurprisingly, really, when you consider the Saudis are in a sort of proxy conflict with Iran over Syria and Assad, and obviously it favours the US position on Russia with regard to sanctions that the Saudis would refuse to cut, given the Russians' involvement also in the Syrian conflict on the side of Assad. So all of those things came together and we saw this collapse. And I think we're now seeing this sort of washing out of the system. We'll see a considerable period of volatility. You know, we hit the low 40s at one point, or mid 40s. I think we're back at 60 now on Brent. We could see some downside or volatility in the near term as those storage levels continue to creep up. But I think, longer term, in the medium term, we will see supply coming off. We've seen the rig count decreasing. We'll see the market tighten up, and I think with the sort of 12 to 18 month view, we can be fairly confident, barring an economic catastrophe, that we'll see oil prices north of 75 again.
I mean, there's two sides to this story. There's the sort of the consumer side, which is saying, woohoo, all prices are down. It's basically a tax cut for the consumer.
That's great, yes.
But for those invested in the region, it has been quite a shock. But you're confident then with that timescale, sort of another 18 months down the line, we'll see a normalisation of oil prices around 75?
Yeah, I mean, I think we were quite fortunate in seeing some of these coming. We don't always get predict macro themes correctly. And of course, we're a sort of bottom-up approach at our fund. But I think, once you see the situation stabilise, once you see supply begin to contract with the impact of less drilling, and once you see declines kick in, particularly in say, Russia, where there's obviously sanctions regime, it's hard to get new investment in and drill new wells, you'll see oil prices stabilise higher.
Looking then at the other sort of popular commodity theme, it's gold. Investors love the gold story.
Yes, the gold bugs.
For years, it was the sort of safe haven for so many. You only needed to sort of Google a gold investor and everybody would say, pour your money into it, they can only go up. It's gone quiet over the last sort of 18 months. What can we expect from that commodity?
Well, I think, Emma, it's a really good question. I think people are caught between fearing inflation, fearing that quantitative easing will wipe away the value of their savings, the fiat currencies that they own, and therefore gold is seen as a store of value in times of crisis. And more recently, prevailing concerns about deflation, which perhaps have taken some of the shine off the yellow metal. I think investors are caught between those two sort of poles, if you like. I think what does look interesting and encouraging for gold is that obviously we have another round of QE, we have some instability in Europe. That tends to provide support for gold prices. And indeed we've seen, historically, where you see the yield curve becoming less steep in the US, you tend to see gold performing quite well as long-term inflation expectations change. So I think we're reasonably constructive on gold. And indeed, we've been looking at repositioning ourselves for that. You must remember, as an equity investor, we have to invest in gold miners, and generally speaking, rather than the commodity itself. And generally speaking, they've been pretty good destroyers of value over the last 10 years. So you have to be very careful, particularly investing in the producers of gold rather than the gold itself.
Michael, thank you very much.
Thank you, Emma.
This is Emma Wall from Morningstar. Thank you for watching.